Welcome to another accounting lecture with the financial controller, Bill Hanna here. In today's video, we're going to be discussing the chart of accounts, and we're going to be going over the basic definition and why we need it for, and then I'm going to show you how to set it up from scratch for an example company in a way that's going to make sense for three different parties. The first one is you, the accountant, in a way that's going to make sense to you and your daily work. And secondarily is going to be management and investors, and how do you read the financial statements. So we're going to draw a line from the financial statements back to the chart of accounts. And then the third party is the auditor, who's going to be auditing these financial statements. So we're going to make sure that it's going to make sense for all these three parties. This is the topic of today's video, so stick around. All right, so what is the chart of accounts? Well, the chart of accounts is just a fancy way of saying the list of accounts or the listing of the accounts. And these are all of the financial categories that go behind the scene in creating the financial statements. So for example, if you look at the income statement, the first line item you'll see typically is sales revenue. Well, in the chart of accounts, you create multiple accounts, each one representing the different revenue streams. So if your business have multiple revenue streams, let's say three, you create three accounts in a chart of accounts. Each one of them will capture the activity in each one of these revenue streams, right? And then when you create the financial statements, you can go ahead and group these three different accounts into one line item, sales revenue on the income statement. So it's pretty simple. It's just a listing of all of the accounts that go behind the scene to categorize the business transactions, and then you can group these together and create the financial statements. All right, so the example company we're looking at is a software company called SpaBooker, and SpaBooker is in the business of creating a marketplace for spas. If you are a consumer and you're looking to book a spa treatment, you go on the website and you book a spa treatment just like you do with Uber and Lyft and these kind of platforms. So this is a software platform, SpaBooker, and you're hired as the controller or the accounting manager, and you're looking to revamp the chart of accounts. You're looking at the chart of accounts to see if it makes sense. And the first thing I like to do is to bring things back to the basics, right? So what I do is I consider the accounting equation: assets equals liabilities plus owner's equity. And then owner's equity is broken down to stock, which is the owner contribution, and then retained earnings. Retained earnings is the accumulation of profit in the business, and it's basically made up of revenue minus expenses. Now, with the chart of accounts, typically what you'll see is that you create a set of accounts that begin with the digit 1 for assets, digit 2 for liabilities, 3 for equity accounts, 4 for revenue, and then for expenses, you have a 5 and 6 accounts. The 5 accounts are going to be your cost of sales accounts. 6 are going to be your operating expenses accounts. Now, in just 1 minute here, we're going to go over specific examples of a balance sheet and income statement and how to set up the chart of accounts. But I wanted to show you that in almost every situation in accounting, you can bring it back to the basic accounting equation. The accounting equation here, assets equals liabilities plus owner's equity, is going to have in it all of the different categories that you're going to need to break down on a chart of accounts, which is assets, liabilities, equity. Equity includes in it all of the stock contribution or owner's contribution, and then retained earnings includes revenues and expenses. So the main accounting equation includes all of the basic categories in it. Now, let's go through the balance sheet and income statement and make sense of how to set up a chart of accounts that's going to make our life easier as accountants and make it more intuitive for management to read the financial statements and for auditors to be able to audit the work that you're doing as an accountant. All right, so let's begin with the balance sheet, and what we have here is the balance sheet for SpaBooker Inc. as of January 31, 2022. And the first thing you'll see is cash and cash equivalents under current assets. Now, with the cash accounts, I like to create one account for each of the bank accounts that I have. So if I have 3 or 4 different bank accounts, I like to create one account on my chart of accounts for each of those. And the reason is, if you combine these bank accounts into one account in your chart of accounts, it's going to make it very difficult for you to reconcile the bank at month end. And what I mean by reconcile is that you get your ending balance from the bank statement and match it to your ending balance on the books, and any difference is something that you need to book, an expense you need to record, or an income or maybe cash receipts from a customer that you need to record. This is the bank reconciliation. And if you combine multiple different bank accounts into one account into your chart of accounts, it's going to be near impossible to reconcile a month end. And so it's always going to be better to break these down, one account for each different bank account. This is for your cash accounts. For accounts receivable, I like to have one account for receivables from customers and another for other receivables. And the one for customers, that's going to be my main receivable. I'm going to use that account for all of my operations in the business and recording my billing. When I record an invoice, it's going to be debit to receivable and credit to sales revenue. And so this is going to be my main receivable account from customers, and another for other receivable that's not going to be core to the business. This is other items that I'm going to be receiving. For example, if I have to collect taxes from an employee and remit to the IRS for a stock transaction, I'm going to record that a receivable from the employee and then a payable to the government. That's going to be for the other receivable activity that's not going to be core to the business. That's going to be other receivable. The next major line item on the balance sheet is going to be property, plant, and equipment. And for the property, plant, and equipment accounts, I like to create one account for each type of fixed asset. So if my business, in this case here, Spot Booker, has maybe computer equipment and then maybe office furniture as the main asset classes, I like to create one account on a chart of accounts for each of these items. So I'm going to track computer equipment on one account, and then I'm going to track office furniture in a second account, and then I'm going to create two accumulated depreciation contra asset account, and we're going to be talking about this in detail in future accounting lecture. A contra asset is a reduction to the asset, because basically you'll be accumulating the depreciation for that asset and reducing the value of that asset that way. And all of these principles here are covered in extreme detail in the Controller Academy, which is an online course that I created to help you become a corporate controller. Now, the online course is a comprehensive resource for you, and it's broken down into 5 different modules. The first one is going to be the accounting equation, which is explaining the foundation and the basics of accounting, which is a combination of accounting 101 and 102. The second module is going to be how to record transactions in the real world. And these are transactions ranging from the typical billing and expenses transactions, and also the difficult equity transactions and examples of everything throughout. Module 3 is going to be about month-end close and how to execute an efficient month-end closing process in the real world with examples and preparation of financial statements. Module number 4 is accounts payable and how to run a comprehensive accounts payable process that makes sense. And then module number 5 is going to be about financial statements analysis. So go ahead and check it out. I'm going to leave a link down below. We get to the liabilities section, and under current liabilities is accounts payable. I like to create multiple accounts. So for accounts payable, I like to create an account for my trade accounts payable, which is my payable to vendors in the running of the operations of the business. And then I like to create one for payables to employees. These are going to be all of the reimbursements to employees at month end. So your employees will be spending money on travel, entertainment, going out to meet customers, all these things, right? And they'll be owed money at month end for their expenses. And that's where I'm going to record my payables to employees. And I like to create a third payable account, other payable, and that's the account I'm going to book things in it that are not core to the operation of the business. And an example of that, like I mentioned before, is that if you are collecting some sort of tax from an employee or child support or a certain garnishment that you then going to owe to another government body, then you record the payable here to the government. And we'll go through some examples of these things in future lectures. But for now, I just want you to be aware that for accounts payable, the ideal setup is to have these 3 chart of accounts for accounts payable, payable to employee, and then other payable. All right, up next on the current liabilities is going to be credit cards. And credit cards are going to be those credit cards that you issue in the business to your executives so that they can go out and transact and do business faster with a credit card. And so in this case, I like to create multiple accounts, one for each of the credit cards that I have. And that's going to be easier for me then when I reconcile a month end to the credit card statement if I have separate accounts, one for each of the credit cards. So I'm going to create one for the CEO and one for the CFO. I'm going to include in the account name the last 4 digits of the credit card number, so it's easier for me to identify which credit cards, just in case the CEO has maybe 2 different credit cards, so each one will be identified with the last 4 digits of the card itself. Okay, now for the next item is going to be accrued expenses, and I like to create that into one account in a chart of accounts and then create or manage the detail in Excel. So the detail of accrued expenses is going to be the detail by vendor, and I can manage that in Excel and then create just one account in a chart of accounts to track the liability of accrued expenses, right? If you try to create multiple accounts, each one to track one vendor accrual, So you might end up with like maybe 5, 10, 20 accrual accounts, which is going to make it super crowded on your chart of accounts and make it less efficient for your reconciliation. So I recommend for accrued expenses to create one account and then track the reconciliation of it or the breakdown of it by vendor in Excel. Okay, same thing in the next line item, deferred revenue. So for deferred revenue, I'll do the same thing. I'm going to create one account on the chart of accounts and then track it down in Excel by customer. So deferred revenue or unearned revenue is the revenue that you're gonna earn in the future. So you receive money today, the customer pays you $100 today for a product or service that's gonna be performed or delivered in the future. So you haven't earned it yet. That's why it's sitting here as a liability. Okay, now up next is going to be loans. And so for loans or long-term debt, I like to create multiple accounts, again, each for the different loan accounts. And again, that's going to make it easier for me to reconcile a month end to the loan statement, right? I reconcile my books to the loan statement. It's going to be easier for me, and it's going to be easier for the auditor as well when they're conducting their audit to get one loan statement and compare it to one chart of accounts in the general ledger, rather than combining all of your loans into one account, which won't make any sense. That's for long-term debt. Now for the equity account or the shareholders equity, typically you want to break that down into multiple accounts. And so the first account that I typically see is going to be the common stock at par value, right? So when you issue a stock, par value typically is pennies, right? So maybe like 1 penny, maybe 10 cents. That's going to be the par value at which you're issuing the stock. And then any additional funds you're getting beyond that 1 penny is going to be additional paid-in capital. And so I like to create and track it by funding round. So for example, if I have a seed round, I'm going to create one account to track the seed round and then a secondary account here to track the A round. So I'm tracking the different rounds and the amounts of additional paid-in capital for each of these funding rounds. And then I'm going to create another additional paid-in capital that's going to be for stock options, and we'll discuss in a future lecture how to record stock option expense and how that affects the equity accounts. And so you're going to create an additional paid-in capital for options. And then you'll create one for retained earnings. And that's going to be the account that's going to accumulating the profits in the business into the equity account, retained earnings. All right, let's look at the income statement and come up with the accounts that will go in a chart of accounts from the income statement for SpaBooker. And we have the income statement here for the month ended January 31, 2022. So when we look at it, the first thing we'll see is sales or sales revenue. And you want to create multiple accounts in your chart of accounts, one for each of the revenue streams. And so in this case here, SpaBooker is in the business of being the middleman between consumers and spas. So when you're a consumer and you book a spa treatment, the company or SpaBooker will get a transaction fee, or maybe 10 to 20% of that transaction. So transaction fee is one of the revenue streams. And the other is going to be the platform fees. So the company collects a fixed monthly amount from each spa for being on the platform. So it could be $200, $300 from each spa just for being on the platform. So you want to create two, or in this case here, two accounts in a chart of accounts, one for platform fee and one for transaction fees. So you can track each of the revenue streams separately. Next is going to be cost of sales. And when we get to cost of sales, it's important here to distinguish between two types of cost or expenses in a business. The first one is going to be cost of sales, and then the second is going to be operating expenses. Now, cost of sales are going to be those costs or expenses that are associated with revenue making, right? So in this case here, we have server costs. So I'm using a cloud server like Amazon Web Services or something similar to that. And that's what I'm using to host all of the activity that's going on the website. And that's going to be directly associated with making revenue or making money, right? So that's why it's called cost of sales. It's not an operating expense. Operating expenses are going to be things like rent or salaries to supporting staff and things like that. That's going to be operating expenses. But cost of sale is highly scrutinized because it's going to be directly associated with gross margins. So everybody's looking at gross margins. This business makes 50% gross margin or 60 or 80% gross margin. The higher, the better. And so it's highly scrutinized by both investors and auditors into making sure that what goes into cost of sales are things that are associated with making sales in a business. And so in this case here, we identified that the things that are going to be associated with cost of sales are going to be server costs or Amazon Web Services, and the customer support, salaries, and benefits, right? So you create one account for AWS and then one parent account for customer support, salaries, and benefits. And underneath that, we'll create multiple children account, and we'll look into the setup now in QuickBooks in a few minutes and see how to create a parent-child relationship when it comes to these things. So you want to create a parent account for that houses all of the salaries and benefits, and then children accounts for the sub things, which is salaries, medical insurance, 401k, and all these things. Okay, so that's for cost of sales. Now we get to operating expenses, and these are the overhead expenses that are not directly correlated with making sales. And these are going to be salaries and benefits to supporting staff like general and admin, research and development, and things like that. That also is going to cover things like rent, software expenses to run the business, and other things that you need to run the business. And so for that, you create multiple accounts, and it's going to be one account to track each of the major activities of the business. So rent expense, software expense, and then you get to salaries and benefits. And here also I like to create a parent account that's going to house all of the salaries and benefits, but then children accounts to track each of the activity that goes under this major bucket. And we'll go through some examples in the future accounting lectures on how to record these transactions so that you get more of a full picture onto how to run this operation here. Okay, now the next item is going to be non-operating expenses, and we have multiple accounts, one for federal income tax, one for state income tax, depreciation, and interest. And these are the expenses that are not directly correlated to the operation of the business, so we call them non-operating expenses. So those will go with the 7 accounts, and those are going to be taxes, depreciation, interest. Now let's transition to the accounting software so I can show you quickly how to set up a chart of accounts. And in this case, we're using QuickBooks Online, but your business could be using any other accounting software, NetSuite, Sage Intacct, Xero. There are many different kinds of ERP software out there, but the main principle is the same, which is creating the number logic for your chart of accounts, following the logic of the income statement and the balance sheet, and creating a set of accounts. And so with QuickBooks, when we go into QuickBooks and we go to navigation, accounting, chart of accounts, QuickBooks will come with a set of a chart of accounts that's going to be standard, and you can go ahead and customize it, delete the accounts that you don't need, and create ones that you want to create from scratch. And so in this case, for example, I have cash, and QuickBooks Online is only giving me one account for cash. So I'm going to go ahead and change the name of it and create a secondary account, because if you remember when we looked at cash, we wanted to create 2 different accounts, one for Chase checking 2134 and one for the second Chase account that we have. So the way that we do this is to go ahead and click on edit. So there is a pencil here that says edit. And this allows you to create edits in bulk. And so I'm going to go ahead and change the name of it, Chase checking, and the last 4 digits of the account, and the account number, if I remember correctly, it was 11001, and then I click save. Now I have my Chase account here, and then I have a secondary Chase account for my vendor payments. So I'm going to go ahead and click new. And it's going to ask me here, what kind of account is this? Is income, expenses, banks, assets? So I'm going to go ahead and say bank. It's going to say save account under. I'm going to choose bank accounts, right? And then it's going to say tax form selection. Not super relevant right now, but this could be something that's going to be handy when you prepare the tax returns. The account name, I remember this was the name Chase Vendor Payment. I'm going to paste that here, and then the account number, we chose 11002. Description, The description could be the same as the account name, which is Chase vendor payment. The last four digits 3456. Okay, now you'll be done right here unless you have an opening balance. So let's say this is an account that exists from before and you have a balance. So you go ahead and say the as of date. So you can say beginning of this year, beginning of this month, today, or some other date. So for example, if it's some other date, you go ahead and click that and then you put in the date in this case, and let's say the balance as of March 31 2022, the balance was, for example, $100,000. You put in the ending balance and then you click on save. So now we created our account right here, which is Chase vendor payment 3454. And now from here, you go with the same logic and you go through this chart of accounts. This is the basic chart of accounts that comes with QuickBooks Online. You go through it and you delete or add accounts that you need. So for example, if one of the accounts here, you don't need it. So let's say inventory asset. The business that we have here is not a business that has any kind of inventory. So I can go ahead and click on this arrow here and make it inactive, right? So when you make this inactive, you're not going to see it in this list again. So this way you don't have to clutter your chart of accounts with an account that you don't want to deal with. And you can go ahead and pretty much add account numbers to match the logic that we created here, and either add new accounts or subtract accounts that you don't need in your setup.